high. I am the inspiration that led success soar high. I will achieve, I will fly high. I am the I in SBI.
I'm backed by the nation's trusted bank, SBI, the banker to every Indian.
Hello and welcome to the Business Standard Banking Show, where we bring you the story behind the latest developments in the banking sector. Today is the 9th of November and I am Ruchika Chakravanshi. In today's episode, we get behind how serious is the unsecured loan crisis. For Bankers View this week, we have with us PNB Housing Finance CEO Girish Kauski. In Banking for You, we will tell you all about the scale-based supervision of NBFCs. For expert take, Kamal Bandhopadhyay joins us to discuss some of the recent headlines in the banking sector. At the end of the show, we will tell you the results of the last week's poll and the question for this week. The Reserve Bank of India has been raising concerns over the growing unsecured loan portfolio of banks. Last year too, the RBI had flagged rising risks in the retail loan portfolio of banks and NBFCs. In today's cover story, Raghu Mohan finds out how serious the unsecured loan crisis is for the banks.
The Reserve Bank of India has cautioned about the considerable growth in personal loans. On an annual basis, these accounted for 37.7% of incremental credit in August 2023. Out of these, credit card exposure grew 30%, while auto loans grew 21% and home loans grew 14%. Is a bubble building up in unsecured credit? According to the latest TransUnion CIBIL report, in the second quarter of the financial year 2022-23, these balance level serious delinquencies improved across product categories. But this improvement didn't include credit cards and personal loans, which are unsecured in nature. Even so, the improvement suggests that consumers appear to be managing their credit repayments responsibly.
Give you some perspective around retail credit overall first. I think just to give a context that the retail credit has outpaced the overall banking sector growth. And it is not just the last 2-3 years. If you look at it from a 5-year perspective, share of retail credit has gone up from some 23% of banking credit to nearly 30%. So as of September, we are looking at this to be nearly about 44 lakh crore on a 145 lakh crore gross credit. Now, if you split this into a composition from what is called a secured and unsecured, 75% of this is actually secured and primarily, I would say, driven by home loans and vehicle finance. So that leaves us with the balance 25% of unsecured, which is where there's a lot of discussions in market today. Now, if you look at this 25%, this translates to around just about 7.5 to 8% of the overall banking credit. Now, specific to your question, Raghu, on the asset quality, I would say firstly, in any lending, any fast-growing portfolio, lenders always need to pay close attention to credit appraisal risk management systems.
The TransUnion CIBIL report also says that for consumers having at least one small ticket personal loan, the balance level delinquency rate was 5.4%. This is an increase of 120 BPS since the second quarter of the previous financial year 2021-22. The overall retail loan portfolio looks at the outstanding balances of all retail products, including home loans, auto loans, credit cards, personal loans, and others. Delinquencies on small ticket personal loans have a marginal impact on this overall retail loan portfolio. What needs to be watched carefully are small ticket personal loans of less than 50,000 rupees. They make up for 0.3% of the total retail loan book size at an industry level. Now, while delinquencies on such loans have a marginal impact on the personal loan portfolio, these need to be monitored closely. This is especially so because consumers may prioritize other payment obligations ahead of personal loan payments. This will, in turn, be a wider indicator of financial stress.
The stress is quite real, given the fact that the credit from an unsecured perspective is more towards funding consumption today than any productive use. So just in terms of, from an example standpoint, we have a lot of loans actually being given to people for the purpose of funding consumption, such as purchase of mobile phones, or basically in terms of even lifestyle expenses. When you basically have credit being extended significantly towards such end users, the worry is basically in terms of the stress building up within the system. Credit being given from an investment perspective is always better, because at the end of the day, it is fueling a lot of movement within the economy. But consumption is very short-term focused, and the risk more so in terms of from a consumption standpoint is that it is significantly dependent on the economy doing well. So, and given the uncertain times and the wars that we are actually in terms of seeing, a small pivot in an external macroeconomic environment can significantly have changes in the income earning potential of these people, which is the basis of on which these unsecured credit is extended. And we believe that that could be a significant challenge. So the stress basically in terms of is significantly dependent on how the external environment is doing, and which is also the reason why the regulator is also concerned about the same, the increased portfolio exposures from an unsecured credit standpoint.
The swing towards retail banking was triggered by the weakness in large parts of India Inc.'s credit quality over the past few years. It had led to a pile-up in bad loans and cut banks' appetite to give out corporate loans, and retail became the go-to segment. In its report on the trend and progress of banking in India 2021-2022, the RBI observed that in recent years, banks appear to have displayed herding behavior in diverting lending away from the industrial sector towards retail loans. Empirical evidence suggests that a build-up of concentration in retail loans may become a source of systemic risk. The Reserve Bank is equipped with its policy toolkit to handle any systemic risk that may arise. The silver lining is that the TransUnion CIBIL Credit Market Indicator, which measures changes in credit market health, stood at 100. This is the same level as a year ago.
In an exclusive interview with Business Standard's Manojit Saha, Chief Executive Officer of PNB Housing Finance, Girish Kauski shares the Q2 numbers, the strategy behind degrowing corporate loan book, and more. Over to Manojit.
Hello and welcome to the Business Standard Banking Show. PNB Housing Finance, the fourth largest housing finance company in India, reported 46% year-on-year growth in its net profit to rupees 383 crore for the second quarter. There was a marked improvement in asset quality and sharp decline in credit costs, though margins fell on a year-on-year basis. Girish Khoshgi, the MD and CEO of PNB Housing, is with us today to talk about the Q2 numbers and the strategies going ahead. Mr. Khoshgi, welcome to the show.
Thank you.
Let me start with the asset quality. Gross NPA declined sharply by 197 bips to 1.78% as on September end, mainly due to resolution of a large corporate loan. Retail NPAs also declined. Where do you see the gross and net NPA numbers by the end of the current financial year? I am trying to understand whether you think there is much more scope to lower the numbers.
Good morning. Thank you once again for getting me on the show. So actually, every quarter our GNPA will keep coming down. Now, corporate is now more or less done. We just have one account and the GNPA is less than 3%. On retail, it is 1.74%. So every quarter we will see GNPA even for retail coming down.
Okay, you see improvement from on asset quality front going ahead.
Yeah.
Okay,
that's right.
The second aspect was the corporate loans. PNB Housing has reduced its corporate loan book very sharply, which was perhaps a conscious strategy. But do you think the reduction part is now over and going ahead, the bank will start growing the corporate loan book again?
So it was a conscious call to degrow corporate book because we saw stress. We had NPA close to about 35%. And at one point in time, the book was about 18,000 crores. So we thought we should first work on resolving NPA accounts. bring down the NPA to a comfortable level, degrow the book, and then look at restart. Now, I think both of those are done. So now book is down from almost 18,000 crores to 2,400 crores. And GNPA, which was about 35% on corporate, today it is less than 3%. So it is only, I think, few quarters away from restart. Maybe 2-3 quarters from now, we'll be starting business, corporate business. And it will be a very, very, thought through strategy on corporate. We would focus only on construction finance, select business, in terms of enabling retail business. So we'll do corporate business only to help us grow on the retail front. And therefore, we will do only construction finance. We'll be focusing on select builders, select projects, select locations. So I think that's our strategy. And in terms of the overall portfolio, corporate would not be significant. I think it will be less than 10% at its peak.
Now, coming to the retail loans also, PNB Housing has plans to change the retail loan mix. Wanted to focus more on the salaried class. I would like to know what was the reason for this strategy.
So I think we had taken a call that when we stopped corporate, we thought that we should grow our retail aggressively. And within the retail pool, obviously, we also had higher GNPA on the retail front. And therefore, we thought we need to do small tweak with respect to product and profile. So when we talk about profile, we were slightly skewed towards self-employed. So we thought we need to bring that down to a certain level. And that's the reason why we thought we should change this, because it is known that self-employed would come in at a higher risk and therefore higher delinquency vis-a-vis compared to salaried. And we thought salaried in our book was quite low compared to the industry level, and therefore we thought we need to get that right. And that is where the small shift in terms of increasing salaried and reducing SCMP. I think now it is more or less done on an incremental basis. It will catch up with the book going forward. I think that's the reason why we had to do this.
What is the ideal mix you're looking at from salaried and self-employed?
I think anywhere between 65 to 70 should be salaried and the balance should be self-employed.
So as of now, you are not seeing any impact of higher interest rates on home loans. Home loan demand continued to be strong despite higher interest. Is it?
I would say that demand is very good, quite robust across geography. There is also competition, not that there is no competition, which is why we had a strategy of moving away from super prime, because super prime is really crowded, because all the banks, both private and PSU, and some of the large NBFCs and HFCs, they are focused on super prime, and therefore we have to move completely out of super prime. This is our strategy. So now we are trying to identify certain segments within prime where we can try to build book at a higher yield. So there is huge demand for home loans across all segments, whether it is super prime, prime, affordable. I think there is demand. And therefore our growth guidance is in line, and we'll be able to achieve that.
For our viewers, super prime would mean the very high value home loans, more than a crore. Is it right?
Super prime is basically where a lot of private banks and PSU banks would focus, because these are high ticket and very good profile. The pricing would be very, very competitive. Considering our cost of funds, we thought we should not be in that segment because it doesn't support us on the profitability. And also, we had started affordable business called Roshni. We started that business about 8 months back. Very happy to share that it is on track and there is very good traction. We have reached a book of 750 crores as of last quarter end, that is Q2. And very soon we'll be hitting 1,000 crores, and probably will be the fastest to build a book of 1,000 crores in affordable.
Now on the borrowing part, the PNB Housing's bank borrowing is 40% of the total funding. It has slightly came down from the previous quarter, I think. Is there a plan to further lower it at a time when the Reserve Bank is saying that NBFCs should lower the dependence on bank borrowing?
Yeah, absolutely. We are trying to bring down the bank borrowings because of two reasons. Of course, one, we thought, obviously bank exposure was slightly high within the liability mix. That is one. And number two, we also have various avenues, for a lower cost. For example, now we have access to NHB funds, which will come at a lower cost. So I think next 2-3 quarters time, we will see the bank, which is 40% now, can come down to about 36.5 to 37%, and NHB would go up, and CP, NCD also would marginally increase. So there'll be slight change in the liability, but not too much of a change. There'll be a slight change, but not too much, because I think beyond a point we are agnostic in terms of source. Whatever fits into a cost structure, we would look at that avenue for fundraise and keeping our cost low.
On that note, thank you, sir, for speaking to Business Standard. It was a pleasure talking to you.
Thank you so much.
PNB Housing Finance is aggressive in growing its retail business while also exploring multiple avenues to borrow at a lower cost. That should help them bring down their bank borrowings. As shadow banking boomed in India, the Reserve Bank of India introduced a regulatory framework to ensure that NBFCs comply with bank-like rules to avoid any systemic risks in the sector. Recently, the central bank also revised the framework to avoid indiscriminate imposition of stringent regulations on NBFCs of all sizes. What is scale-based regulation system for NBFCs? Kasturi Akhil answers in our next report.
In 2021, the Reserve Bank of India rolled out a 4-layer regulatory framework for non-banking finance companies or NBFCs to ensure there are no systemic risks in the NBFC sector. Under the framework, NBFCs are classified into base, middle, upper, and top layers based on the assets and liabilities they have, the kinds of activity they are engaged in, and the degree of risk they pose to the financial system. The scale-based framework addresses different areas of regulations like capital requirements and governance standards. In the discussion paper proposing the framework in January 2021, the central bank suggested the base layer will consist of non-deposit taking and non-systemically important NBFCs. These NBFCs will continue to enjoy moderate regulation. The middle layer will comprise deposit-taking NBFCs and systemically important non-deposit taking NBFCs. Lastly, the upper and top layers will include the systemically significant NBFCs covered by a stricter set of bank-like rules. In September this year, the RBI announced a list of NBFCs that will constitute the upper layer under the framework. The list includes 15 systemically significant NBFCs like LIC Housing Finance, Bajaj Finance, and Shriram Finance. These 15 NBFCs will be subject to enhanced regulatory requirements for 5 years at least, the central bank said. The RBI also said that once NBFC is recognized as an upper layer NBFC, it will have to meet enhanced regulatory requirements even if it doesn't meet the criteria for being an upper layer NBFC in the future. Asset size and scoring methodology are some of the ways in which upper layer NBFCs are identified. In October, however, the RBI revised its scale-based regulatory framework. It eliminated the classification of systemically important NBFCs. Earlier, even small-sized finance companies with assets above 500 crore rupees were exposed to stricter regulations because they were classified as systemically important. Now, NBFCs with assets above 1000 crore rupees will be a part of the middle layer, and therefore only those will be subject to more stringent regulations.
I am the blue of the limitless sky. I am the inspiration that led success soar high. I will achieve, I will fly high. I am the I in SBI.
I'm backed by the nation's trusted bank, SBI, the banker to every Indian.
So 15 NBFCs will be subject to enhanced regulatory requirements for 5 years at least. Moving on to our next segment, the expert take. This week, I spoke to our consulting editor Tamal Bandhopadhyay on the rising retail loan portfolio, falling CASA, and how immune is India's monetary policy to Fed rate hikes. Here's the chat. Hi Tamal, welcome to the Banking Show. The earnings season is over, except for one bank's results that have to come. Every bank we are seeing that the low cost CASA, the current account savings account number, is down. How serious is this concern?
Ruchika, rightly, your observation is correct that almost every bank CASA has been down if you see over a period. So this is the fallout of the deposit rate war. As you know, the banking sector's credit has been growing, but deposits, there are two ways of looking at it. One is this, the saving community is finding other ways to park money and get better return. Like for instance, as we speak, the mutual fund AUM, even though debt is not a large part of it, probably 18% odd, but AUM is now 48 trillion plus as we speak, in around 48 trillion in September. And bank deposit is close to 196 trillion. So mutual people are investing in money in mutual fund. So this is equal to State Bank of India's deposit base. What is the AUM of the mutual fund industry? And they have been growing rapidly. And as a result, that's one part of it. Second part of it is the savers, the saving community, those savers which traditionally keep more money in the savings bank account. Now they're shifting it to FDs, fixed to earn more because of the higher interest rate cycle that you are going through. So some of the banks have raised their savings bank account, which is freed now to 7.25, even 7.5%. Which is something unprecedented. We've never seen that. So there is a war on the deposit for deposits on the banking turf. But the bankers, if you say, they said, look, if you pay a little more, it will not attract deposits. The better way of looking at it is just to offer you all bundling, all kind of products to you and better customer care. So there's an offshoot of that probably for the first time, customer is taking the center stage and bankers are concerned about customer.
Other thing that the RBI has been raising with banks is the increasing retail loan portfolio. Last year also they had raised these issues. How serious is this issue according to you?
Well, if you see some of the banks have changed their business model and they're going into largely into retail, and a few banks have not changed, but they are always into retail. That's the kind of thing. Now within retail also there are different kind of things. There are different kind, the secured and unsecured loan. Now my understanding is this, even though the bankers would not admit openly, but there are some cracks or slippages being shown in the retail portfolio. They're probably not getting into the NPA category as of now, but because of high interest rates and people's, everybody, those who have got into the, say, suppose a mortgage home loan at a separate rate 3 years back, which was pretty low, and now they have gone up. So they are finding it difficult to service the loan, and if at all they are servicing only the interest part, not the principal amount. So as a result, that's only one instance. So my understanding is this: there are some slippages, and which technically called SMA 1, SMA 2, like the people are not being able to pay up to beyond 30 days, it becomes special mention account 1, and beyond 60 days, special mention account 2, and only if it goes beyond 90 days, then it becomes formally NPA.
The other big headline that we saw this week came from the Chief Economic Advisor, V. Anantha Nageshwaran, who talked about how there is no pressure on RBI to hike rates, even if Fed increases rates by 25 basis points or even twice that. So where is this resilience, if I may say, of India coming from?
Well, that's the stand India has taken, and both the government and Reserve Bank of India governor. They're not using the word decoupled as such, but which is meant is this: we will not be affected by what's happening in US. If you remember, traditionally, US Federal Reserve is the driver of interest rates. In the past, Governor Raghuram Rajan spoke about that openly. And now we are not referring to this, but we are talking about that our macroeconomic stability is pretty robust. Our financial system is systemic stability is also pretty robust, and we can manage our things on our own because we have substantial amount of foreign exchange reserves. And if you see the interest rate cycle, also US has been much sharper than in India, and not only the policy rate, even how the the other rates like rate for mortgage rate has reacted, or say government bond has reacted. It's a very sharp movement. India has tackled the COVID pandemic and the aftermath in a different way. Our interest rate did not go up that much sharply, so we are exuding confidence that look, we don't need to be dictated by US Federal Reserve's policy decisions. It is our macroeconomic realities which will, on basis that, will take the call.
Well, certainly the times have changed, and it is correct that even RBI governor has said that our domestic policies are driving our monetary policies. Our domestic reality is driving our monetary policy. Of course, we will watch for Fed rate hikes and also keep an eye on the oil prices, which could play a dampener as far as interest rate goes. Thank you so much, Tamal, for joining us today and sharing your insights.
Thank you.
It is time now for our poll results. Here's what we asked you last week. Would you take a fresh consumer loan this festive season? Only 17.5% of our respondents said yes, while the remaining 82.5% said they had no plans to take fresh loans this festival season. As you are shopping for the festive season, many of you must be using the UPI platform to make payments. Did you know that only 3 companies account for more than 90% of the combined market share in UPI transactions? Google Pay, PhonePe, and Paytm have been dominating this segment. The operator of digital payments infrastructure, National Payments Corporation of India, or NPCI, has been talking about capping this market share to encourage new players and achieve a market equilibrium. In this context, here's what we are asking you this week. Should there be a cap on market share of UPI players? Our poll is open today, that is Thursday, and you can respond on Twitter, Instagram, LinkedIn, Telegram, and our website. We will be back next week with more news and analysis. Thank you for watching.
If you like this video, share it and subscribe to Business Standard. For more news, views and insights, log on to www.business-standard.com. Do also follow us on YouTube, Twitter, Facebook, Instagram, Telegram and LinkedIn.
I am the blue of the limitless sky. I am the inspiration that lets success soar high. I will achieve, I will fly high. I am the I in SBI.
I'm backed by the nation's trusted bank, SBI, the banker to every Indian.